you were talking about your expectations that at least in the first half of next year, there could be, at the very least, a pause from the Federal Reserve as they wake up to the potential recessionary impacts of further tightening and maybe a slowdown in Europe and other parts of the world. What does that mean for portfolios and the way that you are looking at investing? We spoke to Wei Li earlier this week, the esteemed Wei Li of BlackRock. Of course, she said we are hunkering down at this point.
Yeah, I mean, Wei is much more esteemed than I am, so I'll try and build on that. I mean, the main point is that we are not buying this dip. Because it's not a dip. It's actually driven by a shift in the fundamentals of the equity market. We've got a higher rate path. We've got now a rising probability of recession in the US, a very high likelihood of recession in Europe at the same time. And as a result, equities don't look cheap to us. And when you throw in as well that margins, particularly in America, are at an all-time high, real wages have been squeezed. That's the flip side of those high margins. And one of the things that needs to happen in the United States coming out of the pandemic is labor supply needs to recover. And the thing that's going to drive an increase in labor supply is an increase in real wages. So one of the things that's going to help the US to sort out its macro position is actually something that's kind of macro bullish but micro bearish.
So what does that mean? You go to cash?
No, I think there are other opportunities out there. I talked before about the opportunities at the short end of the European and sterling markets. I think also we see opportunities in credit now as well. Credit has repriced. Valuations look more attractive than, say, equities, and the yields have now increased. So this isn't a market where you come out necessarily into cash, but it is a market where we're more cautious. We're looking for signs, particularly from the Federal Reserve, over time, that it is acknowledging the impact it's having on growth. And as I said before, we think the interesting thing is what happens in the first half of next year when the Fed sees what this tightening of financial conditions has done and sees it slowing growth more than it thinks is necessary to actually get inflation back down again.
You came on in April and you called it right on the energy markets. You spoke to Francine. You said, I see further tightness in the energy markets. We are still tight. And the expectations from from OPEC and the IEA is that will continue. How do you invest around that proposition? Because many people come on and say energy, along with healthcare, is a place to find some shelter here. Do you want to be positioning around the energy markets?
Yeah, I think so. I mean, like I said back in April, we see persistently tight energy markets and volatile because the underlying structural issue here is the West, particularly Europe, weaning itself very quickly off of Russian energy supply. You talked earlier about the risk now that Russia cuts off gas supply to Europe, which is a very serious economic risk. The ECB talked about it in its most recent projections. That means that we're going to see a scramble for alternative sources of supply in the West. We're seeing the US begin to increase production, but still it's these very high prices that are needed to bring that on. For that reason, energy, commodities, all going to be in short supply and therefore offer investment opportunities.